About 70% of federal employees enroll in Medicare Part B in retirement, and most federal employees understand that this may require them to pay two premiums during retirement to cover both FEHB and Medicare. But some individuals are surprised or unaware that they may be at risk of paying an additional Medicare charge beyond their standard premium. This extra charge is commonly referred to as an IRMAA, which stands for Income-Related Monthly Adjustment Amount. During this video, we're going to first cover some background information about how the IRMAA works. We're then going to discuss who may be at risk of paying an IRMAA. After that, we're going to highlight some ways to reduce or avoid this extra charge. And lastly, we're going to discuss what you need to do to modify or appeal an IRMAA. But before we cover those critical points, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. The IRMAA surcharge was initially established in 2003 to help increase the financial stability of the Medicare program. Since then, it has gone through several changes. Currently, the IRMAA surcharge applies to Medicare Part B and Part D. Most federal retirees don't enroll in Part D because they have adequate prescription drug coverage through the other healthcare benefits. However, enrollment in Part B, which covers doctor visits and outpatient care, is very common among federal retirees. Medicare Part B premiums and the extra IRMAA charges that are associated with it are based on your household income. Most retirees will only have to pay the standard monthly premium amount for Part B. But one of the biggest misconceptions about the IRMAA is that it only affects high income earners. Yet, it's not uncommon for federal retirees who were never in the top income brackets during their career to potentially face IRMAA charges in retirement once pensions, Social Security, and distributions from investment accounts start to kick in. Each year, the Social Security Administration works with the IRS to figure out who needs to pay an IRMAA. They use your Modified Adjusted Gross Income, or MAGI, from 2 years ago to decide. For instance, your MAGI from 2022 will determine your IRMAA for 2024, and your MAGI from 2024 will determine your IRMAA for 2026. So in other words, for most people, their Modified Adjusted Gross Income at age 63 will determine whether they have an IRMAA payment when they start Medicare at age 65. There's no specific line item on your tax return for MAGI, but the easiest way to figure it out is by looking at two separate lines on your 1040 tax form. You'll first need to identify your adjusted gross income, or AGI, which is line 11 on the 1040 tax form. You will then need to locate your tax-exempt interest income on line 2A of the form. The sum of those two numbers will be your MAGI. The other important point to note is that the IRMAA surcharges are organized into different income brackets based on your tax filing status. This chart shows the different IRMAA income brackets for 2024. The IRMAA brackets are different from the typical tax brackets. Once you get beyond the income threshold for the standard premium, the IRMAA brackets are relatively narrow. Also, the IRMAA brackets work like a cliff. If you earn even $1 over the limit, you'll pay that bracket's IRMAA amount. As an example, if you file single and have an annual income of $103,001, you'll pay about $70 more a month in premiums. This chart also shows how the premium can increase on a monthly basis for the other income brackets. These numbers generally adjust each year for inflation. There are certain situations that could put you more at risk of an IRMAA in retirement. So I want to share with you 5 common scenarios that could cause you to face a Medicare IRMAA. The first scenario is married households who file jointly and have one spouse who's still working. The combination of one spouse's full-time income and the other spouse's retirement income could cause their total household income to exceed the standard level. For federal retirees, this can be a challenge when one or both spouses rely on the retired spouse's health insurance for medical coverage. Another situation that can lead to a IRMAA is large withdrawals from your tax-deferred retirement accounts like the traditional TSP or traditional IRA. Some retirees take sizable distributions to pay for large and irregular expenses such as home renovations, car purchases, and vacations. These withdrawals can push you into one of the higher income brackets. A third situation that can lead to an IRMAA is Roth conversions. Many people use Roth conversions to reduce future tax liability, but they can also present tax challenges since they are taxable events in the years that they occurred. Just like a large TSP withdrawal, a large Roth conversion can bump you into a higher income bracket. A fourth situation that could put you at risk of an IRMAA is selling real estate. Luckily, most retirees can exclude up to $250,000 of their profits from the sale of their primary home if they're single, and up to $500,000 if they're married and filing jointly. However, if you're selling a vacation home, investment property, or vacant land, you may not qualify for those tax exclusions, which could lead to a large capital gain and increase your gross income. Lastly, required minimum distributions, also known as RMDs, could cause you to incur an IRMAA charge. Many diligent savers are affected by an IRMAA because they have done such a great job of putting money away during their career. Once they reach the age to take RMDs, they could be saddled with very large distributions. A good thing is that some pre-retirement planning can help you avoid triggering the IRMAA penalty. One thing you can do is balance your savings. During your career, you can balance your savings by contributing to both traditional and Roth accounts. There's a trade-off between getting an upfront tax benefit while you're working versus getting a tax break on the back end during retirement. Balancing your savings does not mean that your traditional and Roth savings have to be equal, but putting some money away in a Roth account can be helpful even if you're on the back half of your career. Since Roth distributions are typically tax-free in retirement, they can function like an additional savings account in retirement for those large and irregular expenses. So instead of taking everything from your traditional account to cover these large expenses, you could take a tax-free Roth withdrawal to cover some or all of the expense and potentially avoid moving into a higher IRMAA bracket, since qualified Roth withdrawals do not count towards your MAGI. Additionally, you're not forced to take RMDs from your Roth accounts, so that's another way that Roth savings can help offset your future income. The second way to mitigate your chances of facing an IRMAA is to time your income. Understanding when certain income will start or stop will help you better manage your income sequence. Timing your income gives you more flexibility with delaying or accelerating certain expenses into years where your income is less likely to face an IRMAA. A common tactic of timing your income is spreading out withdrawals or conversions across multiple tax years to avoid a significant spike in income. For instance, if you need additional income to help cover a large expense, you can split that income over 2 tax cycles by withdrawing part of the funds near the end of one calendar year and withdrawing the remaining funds near the beginning of the following calendar year. A third way to reduce or avoid an IRMAA is through charitable giving. Once you reach the age of 70 and a half, you can make a qualified charitable distribution, also known as a QCD, up to $105,000 to qualified nonprofits each year. Your charitable distribution is set up like a direct rollover, and it could be used to support multiple charities as long as the sum is within the $105,000 limit or $200,000 limit if you're married. QCDs are treated as non-taxable distributions, so it's not included in your MAGI, but the distribution does count towards your annual RMD requirements. Therefore, this strategy is most ideal for those who are taking RMDs and who are charitably inclined. An important thing to remember is that QCDs cannot be made from a TSP or 401k, so you'll first have to transfer your funds to a traditional IRA before making a donation. In the event that you owe an IRMAA, you'll receive a notice from the Social Security Administration. This notice will contain information about requesting a new determination If any of the information is inaccurate or if you have experienced a specific life-changing event in your income or your tax filing status since 2 years ago. Some common life-changing events include retirement, marriage, divorce, or the death of a spouse. If one of the life-changing events apply to you, you can fill out Form SSA-44, or you can schedule an interview with a local Social Security office to appeal the notice. You'll have to provide documentation such as a retirement letter, marriage certificate, divorce decree, or a death certificate to verify your life-changing event. When planning for retirement, it's important to keep in mind that some level of IRMAA may be unavoidable depending on your sources of income. Even though we sometimes go to great lengths to avoid the Medicare IRMAA, there are situations where the benefits of going over the threshold outweighs the cost of the additional premium. For example, that may be the case when doing a Roth conversion or when selling a piece of property. Paying the extra fee can be frustrating, but in some cases, a 1-year spike in your Medicare premiums might be better for your long-term financial situation. Good retirement planning and tax planning shouldn't focus on isolated decisions. Instead, it's critical to look at how financial decisions impact you over the course of your entire retirement and not just 1 year. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, visit our website at www.fedwayfinancial.com. You can also schedule a free consultation by clicking on the meeting link in the video description. Thank you for watching, and we'll see you on the next Money Briefing.